The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Super Thursday continues with Your Money, Your Call.
Good evening, friends, and welcome to the program that can add thousands of extra dollars to your superannuation. This is Super Thursday, Your Money, Your Call Retirement. I'm Sam Henderson, CEO and Senior Financial Advisor at Henderson Maxwell Private Wealth. We do advice, portfolio management and accounting. Now, tonight we have a special investment edition of Your Money, Your Call Retirement. Stock selection, Australian and international markets, top performing stocks, how to cushion your portfolio for market volatility, and as always, your superannuation and retirement questions answered by my expert panel. Now, joining me this evening is Henderson Maxwell's own Tony Davison. You probably see him all over this channel all of the time. He's a Senior Advisor and General Manager at Henderson Maxwell. Philip LaGreca, Executive Manager of Technical and Strategic Solutions at Super Concepts, is also joining me on the panel for the first segment tonight. And in the second segment and for the rest of the show, David Buckland, CEO of Montgomery Investment Management, will be joining us on the panel. Now, this panel is here to answer your questions. There's never a silly question when it comes to your own money, so do get dialing. We'll be answering questions from the second segment tonight. The number to call is 1300 30 34 35, or you can email us super@skynews.com.au. But do remember, callers do get preference. So before we get into it, let's have a look at what's been happening around markets today. Let's have a look at the blue chips, see how your portfolios have been holding up over the last day or so. Hopefully it's green on screens for you. AMP off 2 cents today. ANZ off 22 at 26.85. BHP off 39 to 21.03. CBA off 46 to $74. CSL off $1.09 to $1.09. 109.41. Macquarie Group up 29 cents to 80.84. NAB off 21 cents to 27.68. Over to Ramsay Healthcare off 7 cents today at 76.54, holding strong there is Healthcare. Rio off 72 cents to 49.10. Westpac off 39 to 30.36. Wesfarmers up $1.03 to 43.66. Westfield up 6 cents to $10.54. Woolies up 95 cents. There we go, over 25 bucks. Nice to see for long-suffering Woolies shareholders. And Woodside up 41 cents to 29.86. Now let's have a look at the auction clearance rates and see how your state's performed over the last week or so. New South Wales, 84%. Look at that interest rate igniting the fire even further. Well over the 70s now, and 687 auctions, not bad. Queensland, 125 auctions and 57, that's not bad. Northern Territory, 29% and only 8 auctions. WA, a miserly 21% and 43. Saw rents dropped in WA significantly in the last year or so. So they're feeling the pinch over there. South Australia, 62%. Victoria, 75% clearance rate and 789 auctions. ACT, 49 auctions and 67%. And dear old Tassie, 5 auctions and 50% clearance rate. Now, according to a recent Super Concepts, AMP Super Concepts survey, superannuation contributions dropped by 38% in the last quarter. Phil LaGreca from AMP Super Concepts joins us now to talk about these survey results. A little concerning, Phil, big drop.
Well, yes, it was a significant drop for the quarter particularly, and we really put that down to the uncertainty that was in the lead up to the budget, and then also with the actual budget announcements, and people were unsure about whether the legislation would get through, would the rules actually apply, and so they took I guess you'd say, a cautious approach and didn't make the contributions that traditionally they would have made in that quarter.
Can we say this is going to affect, this long-term uncertainty or short-term uncertainty going to affect long-term retirement plans?
It certainly is going to have an impact, because if these contributions don't come into the system, then people obviously will have less in their super balances. And this is, as we were talking before, this isn't just about SMSFs. This trend was actually replicated with the large funds, probably not to the same extent, because the personal contributions are higher in SMSFs by their very nature than the other funds, but certainly it's not just an SMSF issue. It is a superannuation issue.
And the breakdown of that, is it mainly because of the $500,000 cap, or do you think it's the salary sacrifice contributions or lump sum concessional contributions?
I think it's mainly the non-concessional, the $500,000 limit. And particularly, I think, with the proposal to have it count amounts since July 2007, there were a lot of people who weren't sure had they actually used up their allotment effectively. So that was certainly part of that impact. The concessional contribution, again, it didn't change what you could put in for this year or for last year, and obviously it doesn't affect what you could put in for this year, so it has less concern from that viewpoint.
One thing that surprised me is that SMSF trustees have been raising the amount of cash reserves as the RBA rate continues to go down. What's going on?
I think it's two things I would put cash holdings in SMSFs down to. One is you still have a problem that you always have with super statistics at June. You will always see an increase in cash because contributions come in June, but they don't get necessarily invested in June. So there's a little bit of a time lag between money getting hit in the bank to money actually buying an asset. So you do have that problem. The other element, I think, is we've also got a larger proportion of funds that are in pension phase. So we do have a slightly higher cash holding simply because of that. And I guess you could argue the third point is that trustees have been a little uncertain about where to put the money. So with the volatility, it's like, well, do I take the risk or not? I'm not quite sure. So I'll hold it in cash a little bit longer. And we haven't seen a huge increase in terms of particularly long-term term deposits. We've seen a little bit in short-term, and that's probably because, again, even then they weren't sure what were rates going to do. So, maybe they were thinking, oh, maybe it's actually better to lock in now while the rate is, I would say, relatively good.
And are those trends replicated in the APRA funds as well, the non-SMSF market?
Not to the same extent, because, again, the ratio of pension members to non-pension members is sort of effectively a mirror image. You just only have to think about the age profiles of SMSFs. We've got something like 70% of the members in an SMSF are over the age of 50, whereas in the other side of the superannuation industry, it's the opposite. So you just don't have the requirement for as much cash flow.
Now, you guys have picked up a number of interesting trends here. Another one was the increase in property. Now, obviously, with the interest rates going down, property prices going up, both commercial listed trust A-REITs and also direct property going up in value. Is it as a function of the rise in prices, or are people taking money out of other asset classes and putting it into property?
Well, it's a bit of combination, again, of several factors. One is, if we sort of be blunt, some of the other asset classes fell, particularly Australian equities over the period. So just by default, if they fall as a proportion, the property goes up as a proportion. So you have that impact. And obviously, we've also had even just rise in value of property. But there has been certainly some more money injected. What we did notice, though, was that the money that was injected, a large chunk of it was actually not necessarily into direct property. So they were looking at whether it's property trusts, syndicates, or other structures as a way of getting property access. So that's certainly something that is there. And again, I suppose one of the things is property has always been, unlike the other things, it's the only, generally speaking, physical asset that they buy. Everything else is a financial asset. So
Interesting. Now, let's bring Tony into the discussion. Tony, A-REIT's having a terrific time over the last few years, really, as interest rates continue to drop. Do you think the asset allocations changed a little bit because of the performance of A-REITs?
Oh, no question. As Phil's rightly pointing out, if the asset itself is growing in comparison to the other assets, it's going to continue to bloom. And also, I think, generally speaking, for most investors out there, it's been a top-performing asset class and they'll continue to follow it. How much longer it goes, you don't really know. But for the doomsayers out there coming into the reporting season we're in at the moment, stocks like Mirvac and Lend-Lease have both sort of confirmed that some of the concerns out there at the moment in terms of the performance of REITs, and in particular settlement failures or potential for settlement failures, just isn't prevalent at the moment. So property continues to run pretty well, despite a lot of headlines recently suggesting otherwise. And so it's just an interesting insight as well, Phil. I was just going to ask you, given you've got $3.1 billion in the total pool of assets, assets you're looking at there, there's going to be a fair preponderance, I would imagine, of ASX 20 stocks as well that's sort of represented in there. But that seems to have declined in the stats. Is that correct?
Absolutely. If we go back to June 15, it was about 17.5%. It's down to about 14.5%. So there's been a significant move down in those investments. Partly, I guess, again, part of that would be the performance because, again, we know that the top 20 stocks drive a large part of the index as well. But also because there's been a lot of talk and a lot of discussion about diversification, not just within the different asset classes or to the different asset classes, but even within asset classes. So people are looking for opportunities to get a better return. And so they are looking not just in the top 20. And certainly we've seen that definitely be part of the factor that they're looking for a new place. So the equity holding, funnily enough, hasn't really fallen as much as you would expect when you consider how far the top holding has dropped. And that's because, yes, they've looked for a new part of the equity market to go into.
Yeah, no doubt in the world. 1300 30 34 35 is the number to call, viewers. We'll be taking calls in the next segment. David Buckland's going to join us to talk more about stocks. But before we get to that, Tony, the top 20 stocks obviously not performing so great up till the end of June. So these figures might be a little bit skewed. Since June, we've had a pretty good run in the top 20. How do you think the next quarter's figures might look if we compared them to the June quarter?
Dusting off the crystal ball, you'd hope it's going to be a lot better because it is, for most self-managed super funds out there, it's pretty much the largest asset if cash isn't their largest asset. This is top 20 stocks. But having a look year to date, if we just look at the banks on their own, they're actually including dividends still underwater by about 3.5% year to date. However, if you're in small cap stocks, which, hopefully it's not too far down the spectrum if you're in self-managed super, but you're actually up around about 16% year to date. And so most of the action's actually been at the smaller end of the spectrum rather than the larger end of the spectrum. As you rightly point out, a bit of a catch-up game going on just very, very recently in the larger cap stocks. BHP really picking up its act in the past couple of weeks, and the banks generally sort of holding in line with the index. But overall, some interesting stats out there at the moment that would suggest that larger cap stocks are certainly continuing to underperform the broader market, and all the action's really in the small and mid-cap space, or essentially stocks outside the top 20.
Now, Phil, you made a really interesting point as we were talking off camera earlier, that the amount of money going into self-managed super funds is actually lower than the amount coming out paying pensions. So as a percentage of the whole of the whole super market, so to speak, it's actually shrinking.
Yes, I mean, not significantly, but it has shrunk. About 2 or 3 years ago, if you sort of looked at the share of the super pool that existed, SMSFs were about 32%. They're now sitting at about 29%. And that's not because the pool is actually shrinking in dollar terms. It's simply that, from a cash flow viewpoint, they've got negative cash flow. So if their performance is even the same, if it's even the same as the APRA side, they just have to fall as a percentage overall. So I guess what's also helping, shall we say, keep that rate of decline in terms of the overall percentage is also the fact that there's always new funds being established. The ATO still says we're getting something like 2,000 to 2,500 new SMSFs every month. And so, when you're sort of netting that, that's, somewhere around the 30,000 new funds a year. So you've always got that new impetus. And, of course, to be blunt, a fair chunk of that is actually coming, at least in some part, for people moving out of the other funds into an SMSF. So you've sort of got them picking it up there as well. So it's not just contributions.
And the numbers as a whole, the number of funds, the number of members is growing substantially this year, isn't it?
Oh, absolutely. And that's what I say, if you think 30,000 new funds a year, the ATO tells us the average fund is 1.9 members per fund. Which sort of makes sense. Then, yes, you're talking about 60,000 more people into the SMSF pool. I mean, again, from a membership viewpoint, it's still relatively small. We're talking about 1 million people in the SMSF space when there's, I think, last count, 32 million superannuation accounts.
Wow, it's huge, isn't it?
No, which means we do have a few duplications, obviously.
Yeah.
But it's, it's got the higher weighting of value, because you're running with funds that have an average value of over $1 million. Whereas obviously the average balance per member in the overall super fund industry is a much smaller number.
And just to finish up, you've surveyed about 3,300 funds here, which is a decent fund size. The SMSF market tends to be fairly fragmented. You guys have picked up a fairly sizable chunk of the market in super concepts. So these figures you would suggest would be fairly accurate across the industry?
There's probably a few variances. I mean, probably one of the key differences we have is most of our clients actually have someone helping them from an advice viewpoint. Right. And we can't say that across the board for the industry. So that does sort of give you probably a slightly different outcome when you have advisors, because obviously the advisors will look at not just the investment elements, but obviously also the strategic issues around, should I start a pension, what sort of pension should I start, etc. And that is something that certainly is reflected in the sort of data that we see. I mean, if I can sort of put that into context, the ATO tells us only about 30% of SMSFs are in pension phase, despite the fact that, as I said, 70% of the members are over the age of 50. In our book, it's about a 50-50 split, so half of our funds are actually in pension phase.
Right. And would you suggest, and we'll have to break in a moment, would you suggest that's because that's when they need the advice?
A large chunk of that would be certainly around that, about the fact that that's when they start to really become more focused about the advice question.
Fantastic. Philip LaGreca from Super Concepts, thank you so much for joining us on Super Thursday. Don't go anywhere, viewers. We'll be right back with more after this break. Now, get dialing in the meantime. 1300 30 34 35 is the number to call. David Buckland joining us very shortly.
The new Kia Cerato comes with Australia's only 7-year warranty and a stunning new design inside and out across the range. It starts with the Cerato S from just $19,990 drive away with free auto.
It takes a lot to create new life. Elevit has more folic acid and iron than any other pregnancy multivitamin. Folic acid is clinically proven to reduce the risk of neural tube defects. But it takes time to build up your nutrient levels. So you should start taking Elevit before you start trying. Take the first step for a healthy baby with Elevit, Australia's #1 pregnancy multivitamin, with you every step.
Make your Super Dad's Day at Golf Box. Callaway gloves, 6-pack, now $49. Tailor-made set of 8 irons, half price, $4.99. Ashworth shoes, just $99. Or make Dad's Day with a Golf Box gift card. Now at golfbox.com.au.
Are you getting the best deal on your car or home insurance? QBE Send and Switch makes it 100% easy to see if you can pay less. Just snap a photo of your current policy and email it to sendandswitch@qbe.com.au with your phone number. And we'll call you back with our best deal. Email your current policy to sendandswitch@qbe.com.au today.
All day at the shop, then a night of BAS, wages, creditors, and reconciling the bank accounts. I can't remember the last time I made it home in time for dinner with the kids. Call First Class Accounts now. Our professional national network of qualified bookkeepers can take the stress away by expertly managing your bookkeeping in as little as a couple of hours a week. And the first consultation is completely free.
So give us your books and we'll give you back your life.
Call First Class Accounts now.
A place that finds cruises on sale.
Yeah.
Well, would you try Cruise Sale Finder?
Oh, look at that.
Find your cruise and find it cheaper. It's Cruise Sale Finder's Goodbye Winter Sale, and we have deals on all your favourite cruise lines. Enjoy reduced fares, lower deposits, onboard credits and more. So for amazing Goodbye Winter deals, visit cruisesalefinder.com.au.
The Audi A3 Runout is now on. Purchase the Audi A3 sedan with style and tactic packages. From only $45,000 drive away. The Audi A3 Runout. Timing is everything.
You're a very brave man. If you want a white ant, you'll white ant to my face. You don't go through the back. For 2 weeks you've had open slather. You enjoyed it?
Well, if I come at you, it's from the front.
From the front?
But I didn't leak against you, Alan.
No.
It's all on tape.
All on tape.
Tuesday, join us.
Welcome back to Your Money, Your Call, Retirement or Super Thursday, as we like to call it. If you've just joined us, my name's Sam Henderson, CEO and Senior Advisor at Henderson Maxwell, and joining me now on the panel is Investment Specialist David Buckland. He's the CEO of Montgomery Investment Management, and Tony Davison flanks him. He's a Senior Advisor and General Manager at Henderson Maxwell. Now, if you have a question for us tonight, the number to call is 1300 30 34 35, or you can email us super@skynews.com.au. Every caller tonight will get a copy of my best-selling book, The One-Page Financial Plan, so do be sure to leave your name and address with our lovely producers so we can send that out for you early next week. Now, tonight we are doing an investment special. We've got two gurus in investment on the panel tonight, so don't miss your opportunity to have your portfolio questions answered tonight. Let's bring them into the conversation. David, we're right in the heart of reporting season. What do you like, what don't you like as we sit today?
Just for the viewers' benefit, Sam, we have a scenario through August where I think it must be well over 1,000 companies report their results for the year to June 2016. In this case, they need to be audited, and then they need to be released to the Australian Stock Exchange, and with that comes their annual report, their cash flow, their balance sheet, their profit and loss statement, and often their outlook statement. And what's interesting is you might actually have a very good result, but if the outlook isn't quite up to scratch, the stock might actually get smashed. So Blackmores would be a case in point. Looked like a superb result in one sense.
Double the profit, wasn't it?
Earn over $100 million, double the profit. Yet what they said in a sort of right at the end of their release was that their revenue line for the September quarter 2016 will be down on their revenue line for the September quarter 2015. Now, you can't be on a PE of 30 or 35 when your revenue line is going backwards. And so, the market took to sort of the big stick to that one, and it not that long ago was $220. Today, it's sub $130, and it looks to me like it might go to $110. So it might actually go to half.
Lost $30 straight after the announcement.
Of the recent peak, yeah. But so I'm just saying it's not just about the announcement, i.e., as you touched on, $100 million up 100%. It's about the outlook as well, and that's crucial. So we own a business called Certex. It came up with a great number. It's a medical device business, but again, it wasn't overly positive on its outlook. So it had a good day followed by a bad day. Altium, it's a small cap by Australian standards. AL used the code. Very good number. It's had 2 consecutive very good days since reporting. Isentia is another one we own. 2 very good days since reporting. And then there are a few gold stocks, both St Barbara Mines and Evolution Mining, that gold's done particularly well in the last really 18 months. And not that we own them, but they've done very well. They spent the whole of calendar 14 and the first half of 15 really aggressively cutting their cost base. They benefited from a rise in the gold price, decline in the currency, and so they've got this double whammy of lower costs, higher revenue, and that came through in these 2 companies.
Bit of volatility over the same period, so people tend to run to gold over those sorts of times.
Yeah, that's right, and particularly when we've got a scenario where interest rates have been the lowest since the Roman Empire, I reckon, and
absolutely.
And so people are going, where to next? So I better put a bit of gold in my back pocket.
Yeah, absolutely. Tony, again, mid-reporting season, what do you like and don't like as to where we sit right now?
Well, I think 2 things. Number one, absolutely agree with David. You look at AP and Outdoor, APO's the ticker, and it came off 30%. And again, it's all about the outlook statement at the moment. So where companies are doing particularly well is that not only are they meeting an expectation, but they're guiding pretty strongly about the outlook as well. And that's a really consistent theme. The larger cap companies, I suppose, just switching gears a little bit, for mine have been a very bland set of results. If we just look at the bank's trading updates or the actual results from CBA, what you're seeing there is significant margin pressure, either by way of competition or funding costs from deposits. And at the same time as well, impairments, while they're not actually getting any worse, it's probably been a surprise component, they're probably not going to get any better. better. They're sort of bottoming out as well. So the outlook for banks, while the dividend yield is pretty high, you'd probably argue at this stage that you would think that the rate at which they can pay out dividends is actually going to decline. You know, I think it's Westpac actually paid 82% dividend payout ratio, and historically the major banks are sort of somewhere around a 70% mark. So you'd think that that's under pressure. Again, in large cap land as well, Telstra came out the week before last. Wasn't a particularly interesting result, other than the company's going to spend a lot of capex on one hand, sort of fixing up some network issues, and on the other hand as well, more broadly, sort of investing for the future because they've got to. They're sort of running out of options. In
Let's hope they get some call centres that can pick up the phone quickly. That's all I ask for. Now, we've got Norm on the line from Sydney. G'day, Norm. Welcome to Super Thursday. I know you've got a property question here, so shoot away.
Yeah, thanks for that. Enjoy your program.
Thanks, mate.
My question is, my wife and I have a do-it-yourself super fund. We're both the only trustees. We bought a property, we contracted a property in June 2014, and it's due to settle later this year. Now, in October, we'll be coming into a pension phase, and we're wanting to sell the property. It's obviously increased in value. Wanting to know whether we pay capital gains tax on that.
Yeah, sure. So you're in pension phase. You're over or under 60?
I'm 66, my wife's 64.
Yeah, OK. So as you stand at the moment, there's no capital gains tax up until the 1st of July 2017 inside an account-based pension. In fact, even after July 2017, there won't be. However, if it was a transition to retirement income stream, then you may well have an issue. But I believe you're in an account-based pension phase, so no capital gains tax at this point in time. Great place to be. You contracted over 2 years ago, so no capital gains tax inside pension phase. Tony, any comments around this one?
Yeah, Norm's situation is not an unfamiliar one, and for those with larger accounts out there and particularly concerned about the $1.6 million cap, do give some consideration to realising profits on some of these assets that have done very well for you in the past couple of years. If you are contemplating, particularly within a larger account balance, actually realising sort of the capital gains on some of these assets, use the opportunity before the 1st of July 2017 to selectively pick on those assets that have done well. Commercial properties will certainly be one of those for most out there, where you might in fact choose to sell those ahead of time. But certainly, as Sam says, and it's an account-based pension as it stands right now, you're contracted to do the deal, and basically there's going to be no tax on that transaction.
Very good. Good on you, Norm. Thanks so much for your question. Now, we're going to go to an email here. This one's from Dee. With all the changes a government can bring in, would it be good to buy, or what would be good to buy throughout a lifetime, a range of blue chip stocks outside of super that pay fully franked dividends, leaving them for years and reinvesting those dividends? Not bad in theory. What do you reckon, David?
I think Australians, Sam, have a massive obsession with fully franked dividends, and I think it's often to people's detriment. So if I could just paint a scenario, 10 or 11 years ago, Telstra was paying a 5.5% fully franked dividend, and I think in that 10-year period, the shares have gone up from roughly $4.60 to $5.20. So you've had a 60-cent capital appreciation on a $4.60 share price in 10 years, and you've received a 28 or 29 or 30 or 31 cent dividend per annum over that period. So you've basically got a nice divvy and a very, very, very tiny capital gain because of your complete obsession with a high fully franked yield. Now, there have been a handful of telecommunications companies who have grown their earnings significantly, and they've seen their share price appreciate fivefold or tenfold, or in case of M2 Telecommunications, which is now merged with Vocus, over 10 years, 30-fold. So to me, it's about buying high-quality businesses that are growing, not a bond-type investment that just seems to be going sideways, much like Telstra over the last 10, 12, 15, 16 years.
It is like a big fat bond, but the retirees love it. They love the top 20.
Retirees love it. But,
and we'll talk about the top 20 in a moment.
But you've got to remember, the top 50 stocks in Australia's earnings today are approximately exactly where they were a decade ago. So if you want a bond, buy a bond. If you want to buy shares that go up considerably over a decade, try and buy things that are growing.
Yeah, absolutely. And that's the, I suppose, the trap at the moment. And we'll talk about the expansion in PE and the risks that has as interest rates go down. Tony, your thoughts?
Look, I think there's an opportunity, taking a slightly different tack and just approaching this purely from a tax standpoint, I'd say that yes, there is an opportunity to create a portfolio here because, of course, you get the franking credits which are going to offset any of the income tax associated with a high distribution yield that you'll probably get on those stocks. David's spot on. Do consider capital growth as part of the equation, and do be very, very careful about some of the dividend traps that are out there at the moment. Banks at the moment, I'm not really convinced, are necessarily going to grow much more than distribution yield over the next couple of years because of the headwinds against them in terms of competition. So do bear that in mind. But again, if you're after a simple income flow and a tax efficient one at that, if you have a particularly high marginal tax rate, then distribution and dividend yield targeting is good, but do offset it, obviously, with a quotient of capital gain as well, as David's saying. Pick on some stocks that are growing also.
When we return, we'll have plenty more of your questions on super retirement and investment questions. Don't go anywhere. 1300 30 34 35 is the number to call to have your portfolio questions or share questions answered by my experts tonight. We'll be right back in just a moment.
It takes a lot to create new life. Elevit has more folic acid and iron than any other pregnancy multivitamin. Folic acid is clinically proven to reduce the risk of neural tube defects. But it takes time to build up your nutrient levels. So you should start taking Elevit before you start trying. Take the first step for a healthy baby with Elevit, Australia's #1 pregnancy multivitamin, with you every step.
Welcome to QuickBooks Online from Intuit. Manage your small business finances with it. It's easy to create instant invoices, capture receipts, track sales, expenses, BAS and GST. Get started with QuickBooks Online today and get up to 70% off.
If you leave your car at home and train, bike or bus it to work, then Real Pay As You Drive insurance could save you up to $220. So drive less and save big. Search Real Car Insurance.
Want to sell your home? Want to get top dollar?
You've got to get a great agent if you want top dollar.
You need Open Agent.
So I got onto Open Agent and they were brilliant.
With Open Agent, you can compare the agents in your area, see who gets the best prices, check out seller reviews, and get advice from our research team.
Open Agent took all the hard work out of choosing an agent.
And they were brilliant.
The agent we chose was spot on.
Selling with the right agent means less stress and gives you the best chance of selling your home for more money.
He sold my house for $120,000 more than I expected.
The agent we chose sold our house in just 5 days. And we got way more than we expected.
Simply type in your postcode to get started. Compare real estate agents in your area and choose the right agent for you. It's 100% free for sellers.
I definitely use Open Agent again without any hesitation.
Go to openagent.com.au.
A place that finds cruises on sale.
Yeah.
Well, did you try Cruise Sale Finder?
Oh, look at that.
Find your cruise and find it cheaper. It's Cruise Sale Finder's Goodbye Winter Sale, and we have deals on all your favourite cruise lines. Enjoy reduced fares, lower deposits, onboard credits and more. So for amazing Goodbye Winter deals, visit cruisesalefinder.com.au.
The Audi A3 Runout is now on. Purchase the Audi A3 Sportback with style and technique packages. From only $41,000 drive away. The Audi A3 Runout. Timing is everything.
Welcome back to the Investment Special Super Thursday. If you've just joined us, helping me answer your questions tonight is David Buckland, CEO of Montgomery Investment Management, and Tony Davison, Senior Financial Advisor and General Manager of Henderson Maxwell. He's the one that manages the investments at Henderson Maxwell. And if you are looking for advice or the latest in news, events and super retirement, any of those sorts of things, have a look at our free downloadable newsletter at hendersonmaxwell.com.au. Now, we've got Sanjeev from Melbourne on the line. G'day, Sanjeev. Welcome to Super Thursday. What's your question tonight?
Yes, look, I have a property in my self-managed super fund, and I want to invest the balance of the money in some shares, might be Australian shares or international.
Sure.
And I'm going to retire in, say, 5-7 years' time. So can you recommend me some good Australian shares and maybe some international shares which might pay a little bit of dividend and have some growth left in the next 5 to 7 years, please?
Sure, Sanjeev. Thanks so much for your question. Tony, we'll go to you first on this one.
Look, Sanjeev, I think it depends on where you are in terms of your age. It's the one piece we didn't get, but obviously 5 to 7 years as a realisation point gives you plenty of time to let shares develop. I'd actually pick on, with that sort of time frame, shares that have actually got a reasonable quotient of growth still in them. Now, there's a couple of them on the ASX that we particularly like at the moment. One is Link Administration, LNK. Link is basically attached to the superannuation system, but not on the funds management side. It's actually on the administration side. What they essentially do is look after around about a third of all of the members' statements that go out in the post each year, as well as share administration as well for those who actually hold the shares. Now, this particular company's grown well recently. It's IPO'd only in the past couple of years. It's got a fair way to go as the superannuation system develops, but of course, as people add more member accounts amongst more superannuation providers. That particular company's got a fair amount of growth ahead, we think. The ticker is LNK on that one. Another one we quite like is Isentia Group. ISD is the ticker on that one. It's a media monitoring business. It does a raft of things in the technology space, but predominantly around helping companies better understand the utilisation and the returns they get from their advertising. It's been beaten up recently as a stock, unfortunately, and it's probably not a fair reflection of the results the company's getting and what it's actually doing. So those are two to have a look at, and don't forget, with a 5 to 7 year time frame, while it's not everyone's cup of tea, probably a couple of blue chips in there that we like. CSL and Ramsay Healthcare in the healthcare space, also fairly interesting to you as well.
You're buying Ramsay at $76 or a little expensive at the moment, Tony?
A little bit expensive. We'd probably like to see a pullback in those two stocks at the moment. As healthcare goes, it's had a fantastic run in the past couple of years. But don't forget, if we see a bit of a sell-off in the Aussie dollar, you'll get a fair kick along from CSL in particular.
Absolutely. David?
Well, I think I pretty much agree with a lot of what Tony said. I'd probably add a business called Certex, Sanjeev. It's a medical device business. We talked about Isentia earlier. I agree with that absolutely.
SRX is the code there.
Yeah, sorry, SRX and then ISD. The trouble we're having, Sanjeev, at the moment is that the valuations are pretty difficult. So we've got a lot of cash in our portfolios at Montgomery Investment Management because we're just having trouble finding really great businesses with really great prospects that represent really good value. Internationally, we still like Apple. Another business we quite like is Foot Locker, in fact. Now, Foot Locker has a very, very large franchise with some of the best branded running shoes in the world, Nike being an example. So there's many handfuls of stocks you can buy internationally that represent pretty good value and have a lot of upside. My team at Montgomery, other examples are a business called Essilor. They're a major maker of these little babies, the prescription glasses, and they have something like 30% global market share. They're a French company. Essilor is their name. So there's a handful of global stocks you can look at.
Good on you, Sanjeev. Thanks so much for your question. Now we've got Kevin on the line. G'day, Kevin from Brisbane. What's your question for the panel tonight?
Good evening, Sam. You just had a discussion about Telstra. I wonder if we could dig a bit deeper with the proposed buyback and along with the IAG. And with the Telstra, I think they're a capital component of the buyback tender price is $1.78. Does the panel have any view on IAG and the Telstra buyback?
Sure, let's go to Tony.
Kevin, we've got a slide in there at the moment. We might be able to pull up just on a Telstra buyback, but in simple terms, as you point out, you get $1.78 in capital return, and then you get an unknown amount of money on top of that, essentially as a fully franked dividend. Now, in terms of the complexities with this particular one, there's a pricing period that commences in mid-September, upon which the company then determines the offer price that the company will make and then applies a discount to that offer price in order to determine how much you'll get paid. The bottom line is you're not really going to know whether or not you're going to get a decent return out of the buyback from Telstra until somewhere around about late September. there's a fairly complex process associated with this, which probably put people to sleep if I walk you through it. The key thing is I'd actually put a call in somewhere around about mid-September. The numbers will be a little bit more settled at this stage, but if you are in pension phase, in a self-managed super fund, this is manna from heaven. These deals and this last buyback that Telstra did basically has you receiving franking credits in excess of the share price at the time. So probably worth checking back a little bit later on that one.
David, any thoughts on the Telstra buyback?
I'd accept it.
You just want out of Telstra.
Oh, no, I just think you can use, I just think your money can be more intelligently used elsewhere.
Yeah, OK. And would that be in cash, or would you go to TPG or Vocus, VOC? VOC's everywhere at the moment. All the brokers are talking about Vocus, but, geez, it's had a hell of a run.
Yeah, no, we'd probably prefer TPG at the current price levels.
Yeah, it's still a bit expensive, TPM. What do you...
No, I think it's got upside.
You're OK on that one? Yeah, good stuff. Thanks so much, Kevin, for your question tonight. We've got James on the line now from Sydney. G'day, James. What's your question tonight?
Gentlemen, thank you for taking my call.
Pleasure.
My wife and I have a self-managed super fund. We are in pension phase and we have some Telstra shares. Should we sell the Telstra shares and buy CSL now that the price has come down a little bit?
I would. I would. I like all the noise CSL makes. The little price correction that we've seen, I think that's more of an opportunity, if anything. And certainly if we see it sub 100, would be in there throwing the farm at it. But I like the noise this company makes, and the way they're talking R&D long term, it all adds up, and we've seen that in the price movements over the last 5 and 10 years. Tony.
Yeah, look, Telstra, should you sell it? Equivocally, yes, you should. It's a company, unfortunately, that's lacking growth options, and in the world of NBN, there's no difference competitively for them versus, say, a Dodo or a TPG Telecom or anyone else. So the bottom line is Telstra, in the absence of significant growth in its mobile network, really doesn't seem to have a growth quotient at the moment, hence the $3 billion capex spend in their result, pretty much looking for new business opportunities. I would actually pick up TPG, just as David said. I think about Vocus too, but it would need to pull back a little bit. In terms of buying CSL, take your opportunities here. As Sam said, it's still got a good upside to it, and it's an incredibly well-supported stock. When it sells off, it gets supported again. Do also note it's got a huge amount of sensitivity to the movement of the Aussie dollar. If the Aussie dollar goes up, CSL goes steady or sideways or down. If the Aussie dollar comes down, it should go very, very well again. If you're any good at picking the direction of the Aussie dollar, it's a pretty hard thing to do, then CSL may be a buy. But long term, still got plenty of growth in it, and there is a bit of a turnaround story involved with the vaccine business, which was really part of the reason it didn't perform post the result the other day.
I thought you were going to offer James a job if he knows how to pick where the Aussie dollar's going, because the RBA's got absolutely no idea right now. But Telstra, for a retiree who's looking for a big fat bond that just spits out a tax-effective income in pension phase, would you hold it, or is it just still too boring for you because there's absolutely no growth prospects?
I think if you have 100 units of money, a portion of those 100 units have got to be in big, fat, reliable bond-type investments. But I think people confuse Telstra with other equities that should be exciting.
Yes, yeah.
And that's the problem. So I would treat it as a big, fat bond with a fairly reliable dividend stream, whose share price effectively over the last dozen years has done nothing.
Yes, yeah.
But don't confuse it with a high-quality industrial blue chip company, industrial company. It's a typical Australian blue chip that goes sideways.
Yes, yeah. We've got all this noise and price action around TPM and VOC. Are they going to grab market share eventually? I mean, they're all talking about it. They're all talking about grabbing market share.
Of course, if you've got 80% market share and we have 10 each, then eventually we go to 13 each. Absolutely. And you go to 74. And then eventually we go to 16 each and you go to 72. It's just life. We're nimble, we're hungry, we need to grow, and we're very focused. You're a fat, lazy incumbent by comparison. So, of course, we're going to pick up some market share.
It's going to be too easy for them. That's the problem. 1300 30 34 35 is the number to join the conversation tonight. We'd love to get your investment management questions, portfolio questions or Aussie share questions. We'll be right back after this short break with more of your questions.
Make your Super Dad's Day at Golf Box. Callaway gloves 6-pack now $49. Tailor-made set of 8 irons half price $4.99. Ashworth shoes just $99. Or make Dad's Day with a Golf Box gift card now at golfbox.com.au.
The new Kia Cerato comes with Australia's only 7-year warranty and a stunning new design inside and out across the range. It starts with the Cerato S from just $19,990 drive away with free auto.
At Officeworks, we have everything you need to design a wonderful workspace. Work on the go with a scratch-resistant Moto E 2nd generation unlock mobile, just $144. Make sure your work looks wonderful with a 23-inch HP monitor with increased viewing angles, a low $256. And keep your desk free of wires with the HP Wireless Classic Desktop Keyboard and Mouse, only $28. Make your workspace wonderful with Officeworks. If you've got the big ideas, Officeworks has the lowest prices.
Joining me is Michael Kadari from COSEC. Michael, why is it, do you think, that so many wealthy and successful investors have placed their trust in you?
John, trust is built over time. In the past 3 years, we've been able to demonstrate live on national television our track history. We've picked TPG Telecom, Ramsay Healthcare, Domino's Pizza, ResMed, Certex, Cochlear. It's this performance that's led to so much trust and confidence in us.
So I notice you've outperformed the market on a regular basis. Why do you think it is that you are so successful?
Success is built around consistency and strategy. The strategy we use at COSEC is through a unique filtering system. It's this unique filtering system that helps us pick the right opportunities at the right time.
What's your secret, Michael?
You've got to live and breathe the stock market.
So if you live and breathe it, you must have a stock for John.
I'll tell you that in a sec. But for the rest of you, go to cosec.com.au and register for your free report today.
Style is intoxicating. It's effortless. It's knowing who you are. Style is limitless. Don't let your style harbour inside you. Build it with Austral bricks.
Why would humans leave Earth for Mars forever?
I'm allergic to the planet.
Nasonex Allergy targets 4 allergic responses. It gives more effective hay fever relief than antihistamine tablets. Enjoy Earth.
The Audi A3 runout is now on. Purchase the Audi A3 sedan with style and Technic packages. From only $45,000 drive away. The Audi A3 runout. Timing is everything.
Welcome back to Super Thursday. We've got an investment special for you tonight, and don't forget, this is the show that can add thousands of extra dollars to your superannuation. Joining me tonight is David Buckland, CEO of Montgomery Investment Management, and Tony Davison, Senior Financial Advisor and General Manager at Henderson Maxwell. Now, if you have a question for us tonight, we'd love you to get in touch. 1300 30 34 35 is the number to call, or if you're feeling a little shy or watching us on the repeats over the weekend or on IQ, you can email us super@skynews.com.au, and every caller tonight will get a copy of my best-selling book, SMSF DIY Guide, or one-page financial plan. Depends what stock we've got in the office when I get back, but one-page financial plan is the one that I think we're going to be giving out, so do make sure you leave your details with our lovely producers. Now, we've got Max waiting patiently on the line for us. G'day, Max. Welcome to Super Thursday. What's your question for Tony and David tonight?
Thanks for taking my call, Sam. Sam, my question is, first, don't forget we're still on the map. You can come over here. We need your help more now. All the money's gone.
Where are you, Max?
Perth.
Oh, you're in Perth. Good luck to you.
Bring your roadshow over.
Mate, I saw the rental returns have dropped fairly substantially over there, and those auction clearance rates are looking a bit rough. Everything okay?
I'll give you a bed for the night.
What's your question, mate?
I'm going to lose some pension because of the new rate, the amount you're allowed to have.
Yep.
So if I borrowed money from an institution or from my trust to do some work on my house, would that be beneficial to me?
As long as you spend it all. We've got our Centrelink expert coming on in a few weeks' time. But, Tony, I might get you in on this one. Loans would reduce the total asset base, but does it affect the assets test?
No, not really. If this is your principal place of residence that you're spending the money on, Max, then no, it's not going to have a detrimental impact in terms of savings or those sorts of things the way you would normally think might be the case in terms of the assets test as far as Centrelink goes. So, look, I'd get to those jobs. If at the moment you're actually receiving a marginal age pension, however, you're going to have to spend an awful lot of money on your house in order to get yourself back under the new caps from the 1st of January next year. So the key thing is that, yes, you aren't going to impact your age pension entitlement by spending a bit of money on the house, but secondly, do bear in mind that they are a pretty significant move in the 1st of January next year.
Max, are you still on the line there? We still got Max on the line? No, he's gone. OK, I was going to ask if you've got a young wife at which you can transfer some superannuation to, Max, because that's one Centrelink strategy that we're using quite a lot, where you can actually, assuming you've reached a condition of release, so you're in an account-based pension phase, you can cash money out of your superannuation fund, put it into your partner's superannuation fund, up to $500,000 lifetime cap, in accumulation mode until she attains age pension age, essentially reducing your assets test and therefore increasing the amount of age pension you're going to receive. So there are strategies around it, but there's not many. Borrowing money to spend on your own house probably isn't going to do it. Now, I won't bring David in on this one, but David, we are seeing obviously interest rates go down substantially. PEs, price-earnings ratios, start to blow out on some stocks, and those stocks that don't perform, they don't live up to their expectation in terms of growth, they get hammered. We talked about Blackmores before. There's plenty out there. How do clients or how do viewers buy stocks in this market at the moment?
I think it's very, very difficult. I think it's very difficult, firstly, Sam, because if you go around the world, central banks have pushed interest rates down to the lowest level they've ever been at, period. And this includes the European Central Bank, where interest rates in half the European economies are in fact negative, i.e. you lend the Swiss government $100 and in 10 years' time they give you back $99. So it's an absolute logic. And I think that's happening all around the Western world at the moment. And so what's happening is that the price of money is artificial. And most assets are priced based on that price of money. So i.e. the discount rate would be a classic example. So when the discount rate based on these long-term interest rates is so artificially low, then I think people have got to really be very, very, very careful. And it worries me that my parents' generation are jumping into saying, I used to earn $80,000 on $1 million risk-free, and now I'm earning approximately $20,000 or $25,000 on my $1 million risk-free. And I can't live on this. And I've got to go up the risk curve. And what are you doing by going up the risk curve? You're buying things that are extremely expensive. And so I think a lot of people are going up the risk curve at the most inopportune time. And I think they're doing it illogically. So they're just gambling. They're just chasing assets. It doesn't really matter what it is. It doesn't matter if it's art or if it's property or it's shares. But they're just chasing because they're feeling squeezed. Then you imagine if you're living in Japan or Western Europe or the UK or the States, it's a lot worse than it is here.
Absolutely.
But this is a dilemma throughout the entire Western world. And basically people are just being absolutely squeezed because of these artificially low interest rates.
Yeah, I went to an amazing presentation last night at PIMCO Fixed Interest with all the heads of or CIOs of many of the larger superannuation funds around the country, and in attendance was one of the policymakers former policymaker from the US talking about the election, and also people with a direct link to the Reserve Bank over in the US, and it was an incredible story, and also there was some reflections on where the RBA is headed. They're not likely to go down the bond buying path. They're not likely to go down that path to support the Aussie dollar. What they're more likely to do is to continue to decrease interest rates and follow what's been happening overseas. What that's doing is inflating share prices artificially in Australia, and therefore, in my opinion, creating a lot more risk. And that's exactly what David's talking about. Tony, would you concur with that? I mean, we're holding more cash than we've held for a long, long time.
Yeah, I completely concur with that. I think, you know, let's just look at some individual stocks out there. Look at Sydney Airports, look at Transurban, for instance. Now, they've had stunning runs in the past 12 or 18 months. Think about REITs, or real estate investment trusts, which are the best performing subsector.
25% for the year.
Best performing subsector on the exchange. Why is that? It's cheaper money, it's cheaper interest rates, and that is what's driving it. And it's exactly what David says. If you imply what we call a lower discount rate because the price of money is going down, certain types of assets continue to go up, in theory, infinitely as a result of that. Now, at the end of the day, that's a nexus that has to break at some point. And while we're certainly not calling higher interest rates anytime soon, interest rates can't go down forever. I draw on this one thing that's happened in the past interest rate cutting cycle in Australia. The RBA cuts, the major banks pass on none or only a small amount of that. What does that tell you? For the funding institutions out there, our banks, they're actually no longer able to match that cutting process because their own costs of funding are higher. So we're actually seeing the limits, in my view, of what's actually available to be delivered by the RBA in our system.
And the other thing that fascinates me is one of the key reasons the RBA is lowering rates is to try to lower the dollar. So, you know, race to the bottom obviously is to make our country more competitive, increase exports. So what happens in the half hour after they lower at 2.30, we see the Aussie dollar go down 0.5 cent, then we see it go up 0.7 of 1%. What's going on with that, David?
Well, it's precisely the same as New Zealand. They cut to their record low of 2%. We cut to our record low of 1.5%, and the currency goes up. So I think these central banks are now doing a little bit of navel gazing, saying this is A, not working, B, we've got relatively poor demographics in our countries. We're hurting the retirees. We're hurting the people who are heading towards retirement. We're hurting people who have been fiscally conservative. And we've got to have a big rethink. And I think they're just starting to work it out, that really they're pushing on the string to some degree.
But not showing any capacity to do anything apart from continue to lower, which is hurting retirees. I mean, all of our viewers right now are probably sitting there looking at that cash rate thinking, what the hell do I do with my money? Many of you just holding on for grim life, Tony, looking at this risk in the market. You know, here we are sitting at 5,600, essentially around multi-year highs on the ASX, all-time highs on the US market at 18,600. Just more risky, in my opinion.
Well, exactly, and David hit the nail on the head. You know, it can only go up one direction for so long. So we're sitting on a large amount of cash, and I think, David, you said in your funds you're actually sitting in a large amount of cash at the moment. Why are we doing that? We're looking for an opportunity. If there were to be a catalyst for a risk event out there, a bit of a sell-off or a bit of weakness or even some sideways movement for a while, that might allow some of the stretched valuations we see at the moment to come back our way a little bit and an opportunity to buy some assets.
Do you reckon Donald Trump might be that opportunity to have some cheaper shares coming up in November?
I really hope not, because it's not a comment about about politics. It's actually just a comment on the fact that there really isn't a lot of policy behind it, and it makes it very difficult to know what the other side looks like.
He's up against it. It is unlikely, certainly according to the commentary I received last night at the briefing, that's for sure, but a very interesting process indeed. Now, we do need to take a break. We'll be right back with more of your calls very shortly. 1300 30 34 35 is the number to call in the break. Love to get your questions.
After the 7-seat Kia Sorento won 2 Australia's Best Cars Awards, Cars Guide Car of the Year and Drive's Best Family SUV, we did a lap of honour. Around Australia, Kia Sorento, Australia's best SUV.
At Officeworks, we have everything you need to design a wonderful workspace. Improve the efficiency of your printing with a wireless inkjet multifunction, only $99. Make sure your work looks its best by adding J. Burroughs Premium White Copy Paper, only $19.95 a carton. And back up all your work with a 3TB desktop expansion hard drive, only $139. Make your workspace wonderful with Officeworks. If you've got the big ideas, Officeworks has the lowest prices.
All day at the shop, then a night of BAS, wages, creditors and reconciling the bank accounts. I can't remember the last time I made it home in time for dinner with the kids.
Give us your books and we'll give you back your life.
I'm behind on invoicing and my husband's suppliers are chasing him for payments. There has to be a better way to manage our accounts.
So give us your books and we'll give you back your life.
Are you struggling to balance the bookkeeping side of your business? Call First Class Accounts now. Our professional national network of qualified bookkeepers can take the stress away by expertly managing your bookkeeping in as little as a couple of hours a week. We can come to you, and the first consultation is completely free. Let First Class Accounts look after your books so you can focus on what you do best, running your business.
So give us your books and we'll give you back your life.
Call First Class Accounts now or visit firstclassaccounts.com for your free consultation.
At SEW, we appreciate your plant should always be operating at full capacity. In moments of crisis, we also understand the importance of having you back up and running as soon as possible. Our 24/7 emergency breakdown service ensures you have the best possible chance of minimising downtime. It's in our DNA to ensure your plant has the best combination of quality, service and availability, coupled with rigid backup. So trust SEW Eurodrive.
Email a photo of your car or home insurance policy to sendandswitch@qbe.com.au with your phone number, and we'll call you back with our best deal. Email sendandswitch@qbe.com.au today.
The Audi A3 Runout is now on. Purchase the Audi A3 Sportback with style and technique packages from only $41,000 drive away. The Audi A3 Runout. Timing is everything.
You're watching Sky News Money.
Welcome back to our investment special of Your Money, Your Call Retirement, or Super Thursday, as we like to call it. Joining me tonight is David Buckland. He's the CEO of Montgomery Investment Management, and Tony Davison. He's a Senior Financial Advisor and General Manager at Henderson Maxwell. Now, if you have a question for us tonight, we'd love to hear it. 1300 30 34 35 is the number to call. Every caller tonight will get a copy of my bestseller, The One-Page Financial Plan. Now, one of the biggest problems right now in the share market is trying to get a decent yield, and we're going to bring Tony into the conversation now about investing for yield to try to beat those cash rates without, hopefully, taking too much risk. How the heck do we do that, Tony?
Well, that's the challenging thing at the moment. Really, if you're not interested in term deposits, and that's about as close as you get to zero risk, then you haven't got a huge number of alternatives. Now, there's a slide here that shows a number of different alternatives, but if we just cascade down there, term deposits at the moment, depending on your duration and time frame, might give you about 2.5% to maybe 3% if you're lucky on a bonus. And yeah, there are certain savings accounts out there that might pay a shorter term bonus. If you go to, say, property yield, we were just talking off air about property and some of the yields out there at the moment.
Let's see if we can bring that slide up now if we could, but keep going.
Property yields, if you look at a capital city property yield at the moment, you're looking at 2.9%, and that's before costs, right, in Melbourne, about 3.1% in Sydney. Now, if you back out your costs and that sort of thing, it's infinitesimally low. You've really got to get a capital gain on this property or start to hope for rental inflation to make these sorts of things work.
But that's not happening either. You know, we looked at the WA numbers that have come out today or yesterday. Rents are actually going down. New South Wales rents are going down. I'm starting to see signs up all over the place of units for rent, certainly when I drive through DY on the way to the beautiful North Curl Manly sort of region. And, we are starting to see some pressure in that space. We've got what looks like a major supply glut over the next 2 years, yet as interest rates go down, those property prices keep going up, and so are share prices more recently.
Well, that's exactly right. So if you're not attracted to the investment proposition with property, you start finding yourself either in the bond market. Now, basically, if you're looking for something like a 10-year government bond in, say, the United States, you're looking at 1.5%. David was talking earlier about a raft of countries where on a 10-year basis you're actually lucky to get your money, or sorry, you will get your money back, but it'll get less back than you actually put in. So if we switch our way out of the sovereign bond area and go to ASX-listed stocks, yes, arguably, on some of the major bank shares in Australia, assuming no cut in dividend, before franking credits, you're going to get around 7 or 8% on some of them. But you must assume at the moment the market's starting to tell you something about the fact that those dividends are likely to come under pressure. So, there's very few places at the moment that there's a decent income alternative available for a retiree that's anything north of really 2.5% or 3%, unless you're prepared to take some risk. And this is the behaviour that really low interest rates in the current environment is driving, is this herding behaviour back into, again, stretched valuations and stocks that really are on PEs that don't make a huge amount of sense at the moment. think about real estate investment trusts on the ASX at the moment. While they've had an astonishingly good run, been a very resilient asset class, their yield at the moment is roughly half of where it was 4 years ago. Okay, now it's still more attractive than a government bond.
Substantially higher.
Well, yeah, the PEs are a little bit manufactured in that space, but think about the dividend yield, and that's what you're in it for. It's about half of where it was as a sector from 4 years ago.
All right, we better go to John from the beautiful ACT. G'day, John. Welcome to Super Thursday. What's your question tonight?
Hi, I'd like to know the panel's view on Macmillan Shakespeare. They seem to have reported a pretty good report about 2 days ago, but the share price has dropped close to 20% in the last 2 days.
Had a bumpy ride over the last few years, haven't they? Let's bring you in, David, on this one.
Yeah, so, John, that was a bit of a Blackmore situation in that the numbers on the surface look very good. When you read in great detail their outlook statement, one of their divisions looks like it's going to be under enormous pressure. Probably not necessarily in the next 6 months, but probably the 6 months after that. And the market's very quick to anticipate these things. So it mightn't have an enormous effect on their earnings in fiscal 17, but it probably will have a detrimental effect on their earnings, particularly in fiscal 18. And so the market, although it was a very, very good fiscal 16 number, the market's quite brutal. It just quickly looks through the outlook and says, OK, things are going to be a lot worse in 18, possibly a little worse in 17, and just mark it straight down. So they're very brutal. So what I'd advise you to do is have a very, very close look at their announcement and the space they're in, because it's, as I say, it looks like it's going to be slightly detrimental for them.
Now, Tony, your thoughts on Macmillan Shakespeare?
Look, unfortunately, David's spot on. It's a prospective loss of a major contract that the market's concerned about there. The result itself was pretty healthy, but they're fairly lumpy contracts in terms of the way the company makes its money, and they lose one of these agreements and it really does put under threat the broader business. You know, in the right conditions and with the right things going for it, this is actually a great growth company, but in the results season that we're going through at the moment, see this repeatedly. Companies that are well priced and looking for a perfect result, and they give guidance or intimate something might be under threat. Blackmore's, AP&, Macmillan Shakespeare, there's been a raft of them in the past couple of weeks. They really get smashed, and you know, they're having a really tough time of it. It's actually fundamentally a great company in a good space, and so it's not one to throw out, but at the same time it's going through a phase at the moment where it'll probably be weak for a little while.
Absolutely. And I would recommend taking the opportunity on these stocks to actually just ask yourself the question, is this a short-term dynamic or is this a permanent dynamic? I.e., as Tony says, is this loss of a contract going to be the loss of other contracts? And is this company now going to be under structural pressure, or is it just a one-off? And if it's just a one-off, maybe a very severe share price decline is an opportunity. But if it's structural, so for example with Blackmore's, is the decline in earnings revenue for the September quarter 16 on the September quarter 15, again, is that just temporary or is that going to become permanent? We don't know, but if you've got some analytical ability and you can work that through, then you say, oh, it's only temporary, this could become an opportunity.
Sorry, I was just going to ask about another stock, David, REA Group, that we love. We love this company. It's gone great guns. We're not actually holding it. We almost felt like we got out of it too early in the piece. We got out of it only a few months ago, and we definitely want to get back in, but it's not quite at the sort of price target that we'd like to be buying it at. You know, maybe sub 50 would be fantastic. What's your thoughts on REA Group?
Well, we're a holder and we like it very much. We think that this pullback is temporary, not permanent. We take a view, put simply, that when you're trying to sell property, too much of the value goes to the agent and not enough of the value goes to REA. Now, we think REA offer a great service, but proportionally, far too much goes to A and not enough to B, and we think what will happen is that B, being REA, will just keep taking a little bit more from the agent, because at the end of the day, what a service. You know, you punch in quickly, the suburb, the number of bedrooms, the outlook. You can, over time, walk through the house, and then you decide, I actually don't even have to go and see the house because it just doesn't quite tick the bill. Now, you don't need some guy driving a fast car with a sharp tyre to tell you the pros and cons. You can work out about 85% of that yourself. So we just think that there's going to be some value transfer from agents to REA, and we're talking about REA at the moment getting something like 12% of the value and the agent's getting 88%.
Yeah.
And we're not saying it's much. It might just be 20-80, but the move from 12 to 20 is going to be very significant for that business over the medium term. So,
Absolutely.
So we think this is temporary.
One of the best performing assets for Fairfax, of course, is Domain, picking up a little bit of market share from REA Group. Any concerns around that?
No, none whatsoever, because we think they're both going to pick up market share from traditional agents.
So the value chain is going to change entirely.
It doesn't have to change much either.
Yeah.
You know, if it's 90-10 or 88-12, it actually doesn't have to change much. It just might be 80-20.
Interesting thought. Now, let's bring Tony Davison into the question of Seek. It's a company that we love. Well, I'm always talking about Seek, but right now it's looking pretty expensive at $16.26 today, off 8 cents, but a long way from probably where we'd want to be buying it. What do you reckon?
Yeah, look, we would like to be buyers of Seek at $14.50, $14.80 if it got back there again. It had a blip a few months ago on the back of a quasi-downgrade, and then it rallied straight out of there. It actually had a very good result a couple of days ago. It's guiding quite nicely as well, and it's continuing to invest, which the market was a little bit 50-50 on, but continuing to invest in other ventures as well. Half of the revenue now for Seek comes from offshore. You know, it is a job board we're very familiar with in Australia, but a lot of it comes out of China. A significant proportion comes out of a Brazilian business that they own as well, and those businesses are growing really, really well. They're very different employment markets to Australia. In Australia, we really have only 1 or 2 incumbent job boards. In places like China, you've got 10 or 20 of them, but Seek continues to deliver. You know, it's a really great little Aussie success story. A couple of blokes, a computer in an office, set things up, attracted Packer, and off they went. And, you know, it's never really looked back. And you think about talking about structural changes. It used to be you get the Saturday Sydney Morning Herald or The Age and you get an inch-thick, you know, jobs area or jobs package. The careers section doesn't exist in any way, shape or form anymore, and that's really only sort of 15 years ago. So these sorts of businesses, they'll continue to prosper. They've got unlimited scale, and when they execute nicely, which Seek have, they're going well. For us, we're a buyer at $14.50. I just think about my Scottish genes. I like to buy them a little bit cheap. I don't really like to buy things at an expensive rate. Just at the moment, for us, it's probably a bit pricey.
Absolutely. David, let's talk about Woolworths and Wesfarmers. Woolies starting to show signs of life. New CEO doing a great job. Had a great reputation in the liquor market for Woolies. So he's got the confidence. Looks like he's got the confidence of investors as well. Do you reckon it can go much higher than this?
I think when a company bounces from $20 to $25, the press seem to forget about this problem, and this problem is called Aldi. And Aldi currently have about 350 stores, and I think over the next 8 or 9 years they're going to go to about 650 stores.
Wow.
They're going to grow it probably something like 30 to 33 stores a year.
What's their market share? Is about 13%, I think, and growing rapidly.
Well, it's growing nicely, but at the end of the day, Woolworths EBITDA margins were about 8%. They were the highest EBITDA margins of any grocer in the world, bar none. Now, I think what will happen is that they'll have to reinvest in price cutting to keep up their market share, or Aldi will just keep peppering away and peppering away. And as Australian households, you know, have relatively tight budgets, the Aldi market share will just keep growing and growing and growing. So I just see this as a scenario where this is structural, and Woolworths will have some good quarters and some good half years and some good years. But I'm talking about a 5 to 8 year view. I just see this as being a structural, massive fly in the ointment.
It's a paradigm shift, isn't it? The way we shop.
Well, you know, let's not forget these two companies, Woolworths and Coles, had a very, very cosy little oligopoly, or duopoly actually, Franklin's basically fell apart, etc., etc. And the duopoly is over because of Audi. And Audi are a private company, and they've been very successful in Britain. They've been very successful in France. They've obviously German roots. They're very successful there, and they've come down under, and it's still relatively early days for them.
So you're not holding Woolies?
We do not hold Woolies.
Where's Farmers?
We do not hold Wesfarmers.
Neither do we. 1300 30 34 35 is the number to call. Love to get your questions. We have one segment left in our investment special. Be quick. We'll be right back in just a moment.
It takes a lot to create new life. Elevit has more folic acid and iron than any other pregnancy multivitamin. Folic acid is clinically proven to reduce the risk of neural tube defects. But it takes time to build up your nutrient levels. So you should start taking Elevit before you start trying. Take the first step for a healthy baby with Elevit, Australia's #1 pregnancy multivitamin, with you every step.
Welcome to QuickBooks Online from Intuit. Manage your small business finances with it. It's easy to create instant invoices, capture receipts, track sales, expenses, BAS and GST. Get started with QuickBooks Online today and get up to 70% off.
Hi, I'm Michael Kadari from COSEC. I've spent my entire life creating wealth for my clients and family. And right now, interest rates are at a historic low, so it's a challenge to have your money working harder for you. That's where COSEC can help. In 2012, I tipped TPG Telecom. In 2013, I recommended Domino's Pizza. And in 2014, I picked Ramsay Healthcare. All of these greatly outperformed the stock market. That's why COSEC clients are some of the wealthiest and most successful investors. At COSEC, we have a unique stock market filtering system. And now I can share this knowledge with you, because wealth begins with better knowledge. Just go to cosec.com.au and apply to get your free report. Act now and get cutting-edge research covering some of the best opportunities.
Michael, so what stock should I buy?
When Michael Kadari talks,
well,
everyone listens.
With the Philips Beard Trimmer 7000, trimming doesn't have to be a messy business. Its vacuum system removes up to 90% of mess, so you can trim, and we'll tidy. Be your best you. The Philips Beard Trimmer 7000. The perfect gift this Father's Day, and available now in-store at leading retailers. Innovation in you. Philips.
The Audi A3 runout is now on. Purchase the Audi A3 sedan with style and technic packages. From only $45,000 drive away. The Audi A3 runout. Timing is everything.
Fox Sports is supercharging your weekend with a massive motorsports double. Supercars superstars hit the track at Sydney Motorsport Park.
Thunderous sound of V8 Supercars.
Then Daniel Ricciardo flies the Aussie flag against the might of Mercedes.
Awesome stuff, Lewis.
Supercars and Formula One, live in HD, Fox Sports.
On the next Sky News Real Estate,
never let go of your inner hippie. It's boho, baby. It's cool.
We find out how to make it work in our homes.
And if you've got a passion for the country life but not the funds, maybe you could run a farm stay.
We look at what's out there and ways to make the numbers work for you.
And the Starkitects behind the incredible award-winning The by Crown Tower.
All that and more coming up on the next Sky News Real Estate.
Will South Australia's disease head east? Some of the highest power prices in the world, and the eastern states are heading down the same path. Environment and Energy Minister Josh Frydenberg joins me for Viewpoint Sunday on Sky News Live.
Welcome back to Super Thursday, friends. This is our final segment of Your Money, Your Call Retirement. Now, we have a few more of your questions. We have a question here, an email asking if we might be heading towards another GFC. David, are we heading towards another GFC?
It's unknowable, but I will say that from a valuation point of view, there's two quite good, very long-term indicators. One's called the Schiller CAPE or cyclically adjusted PE, and it's currently selling on about 27.5 times. So this is the PE of the US market based on the average of the last 10 years earnings per share, and it's currently on about 27.5 times, and I think with one exception being 2000, just before the dot-com bomb, it's never been higher. So its average over about 100 years is about 16 times. It's currently 27.5 times. So it's telling me that markets are very expensive, and obviously that's a reflection on exceptionally low interest rates we talked about earlier. There's another very good indicator called the Tobin Cube ratio. And both Tobin and Schiller, I think, went to Yale and are professors there. Anyway, that's basically the replacement value, the value of a company versus the replacement value of its assets. And that's currently at sort of, again, with the exception of 2000, just before the dot-com bomb, is also at pretty much peaks of the last sort of 120 years. So I have no idea if we're going through a GFC, but I do know that valuations are definitely stretched.
No doubt in the world. Not sure about a GFC, that's for sure, Joanne. Thanks so much for your question. But with those very, very low interest rates, naturally we're going to get some PE expansion and some value expansion, which is what we've seen on the certainly on the ASX, but particularly over in the US, sitting at 18,600 at the moment, all-time record. Now, I've got John on the line from Melbourne. G'day, John. Welcome to Super Thursday. What's your question tonight?
Oh, Sam, look, I'm really happy to be here. Listen, I'm a buyer of Monadelphous. I bought it a while ago, and I sold it off when it was coming down, but I bought it back at $6, and it went up so quickly. I couldn't understand how quickly it went up. Probably went up too quickly.
Must have a sore neck, John.
When their result came out, I thought the result was bloody good. The dividend went up, and I looked at all of the reports from the company, and the company report was such that some people read it as negative. I read it as quite positive. And, I think the market took it as negative. And all the results were, we're looking forward to something, but there wasn't anything positive in the wording. So the thing went down about $2.
Yeah, it was a substantial sell-off, that's for sure. Maybe it got ahead of itself in terms of expectation. Tony, was there a bit of expectation management required in the result?
Yeah, basically the company... So the result wasn't bad, and the company, the stock had run very, very hard. So to put into context for those who don't follow, the stock had gone from nigh on $8 to over $12 in no time at all.
John did have a 300% return. That's not bad.
It's a fantastic return, but at the end of the day, it's what you pay for an asset. And at the end of the day, the result was good, solid and improvement, but it isn't substantial enough to kind of justify the share price where it was. So it's really rebasing to where it probably should be, given the strength of the outlook. The mining services companies really had a tough day in the office a few days ago. A suite of them reported, including Monadelphous, on the same day. All of them have been substantially re-rated on the back of, again, there just simply isn't the construction engineering work that these guys specialise in the mining space yet to justify the valuations where they are. Nothing more complicated than that, not really a fair reflection on the company, but the share prices have just gone up an astonishing amount in a very short period of time ahead of the results.
David?
Yeah, I think what's occurred is that over 2015, as the mining sector got bashed up very aggressively on the back of very poor oil prices, very poor coal prices, very poor iron ore prices, a lot of these stocks fell very aggressively. I think Monadelphous peaked at something towards possibly $30, Tony, I can't remember. Anyway, so they got bashed up very badly, and then they turned around with China announcements around about January, February. And then they had a very, very, very substantial run over about 6 months on no real new news. It was just like, let's pump this sector because iron ore has come from 160 down to 30 and back to 60. And oil's gone from, 130 down to 30 and back to 50. And coal's come down 70%, and it's bounced a little bit. So let's just buy these resource service companies because commodities have bounced quite nicely in the last 6 months. So we'll have a gamble on the rally of the underlying commodity prices. But at the end of the day, you know, I said as a scenario, these big mining companies and they're a bit like farmers. They're battening down the hatches. They're basically not spending any money they don't have to spend. So these resource service companies who rely on contracts, the contracts are going to be keenly tendered for if there are any, or when they are. And so there's not going to be a lot of cash around in the space. So as Tony said earlier, you had this nice little 6 month, I call it a sort of a bear market rally, if you like. It's happened. But from an activity point of view, I think it's going to be a struggle for a few years.
Yeah, absolutely. Thanks so much for the question. Now, got another question here on an email. This one comes from Gary in Brisbane. And Gary asks, for my SMSF, I'm looking at ETFs that are focused on the payment of dividends. And he mentions HVST and FDIV. Tony, we were looking at the chart on HVST the other day. Looks very attractive for a retiree perspective. High dividends actually artificially inflate those dividends. Well, not artificially, but they do inflate those dividends. Talk us through HVST and similar style high div ETFs.
They're a little bit of a unique space, but basically they concentrate on companies or assets that are producing a high yield at the time. HVST is quite unique. It focuses on companies in the next 6 weeks that will pay the highest dividend, holds them, receives a dividend and the franking credits, and then moves on. So it's constantly recycling the money. What it's actually doing in that process, of course, is releasing, and the historic numbers on the BetaShares website will support this, about 15% fully franked dividend yield each year. Furthermore, it's actually done on a monthly basis, so you receive those payments once a month. So it's actually a fantastic product for retirees for that reason, plus also the fact that it's partly what we call hedged, which means there's a bit of cushioning if markets get volatile out there. The stock in theory, or the ETF in theory, won't feel the volatility as much. However, that having been said, it's what we call concentrated. It typically holds a small number of names at the same time. So in certain periods, it's actually substantially underperformed the market for a short period of time, particularly from February 15 through to about July of 15, when banks, miners, woolies, you name it, were all getting beaten up simultaneously. Harvester had those. However, for someone who's seeking income, frequent income, monthly, over a long time period, Harvester's pretty good. There are other products out there as well. There's Vanguard's VHY, there's iShares as well. There's a host of ETFs, again, that concentrate on dividend yield and have a similar sort of a process and approach. They are pretty good for a retiree, but please understand that all of these products have their nuances, as I mentioned before, and it doesn't necessarily mean you should bung all your money in them. They probably make part of a constituency of an overall portfolio.
Yeah, no doubt in the world. Good response there, Tony. Unfortunately, viewers, that's all we have time for tonight in our investment special on Super Thursday. Thanks so much for all your wonderful questions and helping your fellow viewers understand super and retirement, and particularly investment tonight, a little bit better. If you are looking for advice for your portfolios or strategically for your SMSF or super portfolio, have a look at my website with Tony at hendersonmaxwell.com.au, and do make sure you sign up for our weekly e-newsletter. Special thank you to David Buckland. He's the CEO of Montgomery Investment Management, a regular here on Sky News Business, and of course Tony Davison, Senior Financial Advisor and General Manager at Henderson Maxwell. My name's Sam Henderson, CEO of Henderson Maxwell, Senior Financial Advisor. Thanks again for joining us tonight on this special edition. We look forward to seeing you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.